As investors, we all know the good old adage, buy low and sell high, as it's often echoed across various mediums, misleading the everyday retail investors out there like me and you. But there is in fact another way, and in my opinion, a much better way to go from rags to riches, so to speak, and that's through dividend stocks. 7 of which I have for you today, just after we unpack and break down some of our need-to-know macros. With that, let's go ahead and dive right in. So just before I run down this list of 7 dividend stocks telling you that you have to buy them right now, I first want to start off with some of our macros, because this past week presented a lot of need-to-know macro bites for all of us, whether you're invested in the stock market or not. And I briefly want to talk about why I chose 7 dividend growth stocks as opposed to just some high-yielding dividend stocks. From there, we'll fly right through our list today. Now, I want to start with our macros, because this past week, we had what I would consider our last mega event of 2023, which was the Federal Reserve's last FOMC meeting of the year, where they discussed their chess moves against inflation, a rather formidable yet incredibly stubborn enemy. And the Federal Reserve ultimately decided that they were going to keep their current position regarding their rate range of 5.25% to 5.5%, which makes sense given the latest CPI data once again depicted inflation trickling down, coming in at 3.1% in November. Of course, we also see data across the board also depicting signs of a slowing economy, which has been exactly what the Federal Reserve has been striving for all along. Yet keep in mind the Federal Reserve does have this 2% inflationary goal that they are quite adamant about ultimately hitting, meaning the question we have to ask ourselves as investors is, when will the Federal Reserve actually reverse course on these interest rates? And furthermore, if interest rates are elevated for a prolonged period of time, how exactly will businesses fare? Likely not well. As I say, it really becomes a survival of the fittest like type of environments for companies. Now, ultimately, this means that me, you, and every investor out there really has to be focused on quality companies, as we should, but this certainly won't be the time to then play your odds with all of your capital at the Vegas table of the stock market. Which leads me to the 7 dividend stocks for the week ahead, noting here that they are dividend growth stocks. Now, why growth as opposed to just say your run-of-the-mill dividend stocks or high yielders? Well, first, I want to clarify that high yield dividend stocks aren't bad, but they often lead to a stock's price falling due to the risk of a dividend being cut. Now, that's ultimately called a yield trap, which we want to avoid at all costs. Instead, it would be best for us to focus on stocks that we can invest into for the long term, not worry all too much about, while collecting cash flow for months, years, and hopefully what is decades to come, which is where dividend growth stocks then come in handy for all of us. So let's get kickstarted here now with our first dividend stock on the list. It's a medtech behemoth, Medtronic, ticker symbol MDT, which is solely focused on medical devices, meaning unlike, say, Johnson & Johnson or some of these other mega healthcare players that are out there with various segments, Medtronic will waver in market volatility given its lack of segment diversity. And we can see that's the case because it tanked during COVID. It then rebounded because it had an ability to deliver through on ventilators, but then ultimately got wrecked by all the supply chain mayhem, as well as inflation and cost cutting by hospitals. However, we then finally began to see now green as it began its ascent, up now by 5% already on the year, trading for $80 per share. And as mentioned, Medtronic is really that long-term type of investment. So zooming out to the past decade, we see over 78% worth of appreciation, with analysts still forecasting over 10% worth of growth here, coming up to a share price of $88.13 per share, all while hedge funds pour millions back into Medtronic, buying more than 4.4 million shares last quarter. Now, according to Simply Safe Dividends, an incredibly safe dividend stock here, scoring a 99 on dividend safety with their 3.45% yield, and scrolling down to review their growth, plenty of it, roughly 8% over the last 5 years. Next up, a never before mentioned stock on the channel, we have Jack Henry & Associates, that's ticker symbol JKHY, which reminds me of Jack Daniels, but we're not talking about liquor here. We're talking about a technology solutions company and payment processor, which I honestly think flies under the radar for many of us dividend investors. But have a look at Jack Henry's chart here, because we're down by 4.3% on the year. We can zoom out here to their 10-year chart and applaud their 223+% worth of appreciation. Now, analysts remain very bullish on this payment processor, with that share price notching up to $170.67 per share, while we see hedge funds taking a little nibbles here on the stock as of last quarter. However, as a dividend investor in the game for the long long term, we see another beautiful safe dividend scoring a 99, given its lower yield only coming in at 1.25%. But the magic will remain here in the growth. As we can see, they have a 33-year streak, growing that dividend by over 8%, at least over the last 5 years. Now, investors, there's 2 dividend stocks out of the 7 total, meaning we have 5 more to go. But just before we cover them, we're almost at 10,000 subscribers, and I'm looking to grow this channel. But I need you to do that. And in knowing roughly 70% of you aren't even subscribed, it's just about time for you to join me on this journey by subscribing. Literally, if you do anything today, let it be joining me on the journey, because I can tell you this, we are just getting started here on a financial freedom journey, and we're doing that together. Now, tapping on the thumbs up button is the cherry on top, but with that, let's get back to it here with Hormel Foods, ticker symbol HRL. It's a food processor with over 40 brands that I would bet my dividends on, that many of them are actually in your pantry or fridge as we speak. Whether it's Skippy peanut butter, Spam, or all these Valley Fresh products, I'm confident that we're going to be in business for a long time coming with Hormel Foods. So when it slides, and it's down by over 28% per year here, on the day, trading for $31 per share, and we're talking about a low PE ratio at 22 for Hormel Foods investors, this one is something you should add to your grocery list. And I'm talking about now this 10-year chart that shows 74% worth of appreciation. Not to mention, we also have hedge funds who have just been scoring more shares worth of Hormel Foods, from Maverick Capital to Fisher Asset Management and Gotham. But as a dividend investor, of course, here we are looking at these dividend insights. We can see a dividend yield here coming in at 3.57%, which has been rated by Simply Safe very safe. And of course, now taking a look at the growth, we get 8% worth of growth over the last 5 years. Up next, Honeywell International, its ticker symbol HON, which manufactures anything from automotive products and control technologies for, say, heating systems within your home, to even aerospace solutions. And right now, it's actually down on the year like the rest of the mentions today, but trading for just $201 per share at a rather low PE ratio for Honeywell, coming in at 24.5. It's a reasonably valued overall here, but talking about 200% now worth of growth over the last decade, with plenty of analysts who only remain optimistic about the company's future here as it bounces back up about 10% to $221 per share. And jumping over to Simply Safe Dividends, we see yet another 99 safety score with a 2.14% dividend yield and a lot of growth, over 8% worth of growth over the last 5 years. Now, speaking of a low-key defense industry player, I want to divert your attention to one of my favorite dividend-paying companies that actually is the largest defense contractor in the entire world. We're talking about Lockheed Martin, ticker symbol LMT, which has been having quite a year, to say the least, testing just how low it can go. But all in all here, we see when the war between Israel and Hamas broke out, it did prompt quite a jump here in the stock share price. That makes it interesting at $451 per share, still at a PE ratio right now of 16.3. Now, why do I love Lockheed Martin? Well, the reality is this world, unfortunately, will not really ever be in a total state of peace, meaning war will be inevitable and defense contractors like Lockheed Martin will be in business. However, when it comes to Lockheed, their biggest client is the United States government and allied forces, so business will really continue to boom. Just this past month alone, nearly $200 million contract with the U.S. Army, and then last month, another $100.89 million Army mod contract as well, to which we have plenty of growth over the past decade, as we can see over 324% worth of it, with analysts who still forecast growth here coming up to $482.27 per share. It's nearly 6.7% worth of upside. Jumping over to Simply Safe, a safe dividend score here of an 84. That's not as high as the others, but still very safe with a dividend yield at 2.79%. And we have 9% worth of growth over the last 5 years. And if you're really looking to soar when it comes to a dividend stock, we have United Parcel Service, its ticker symbol UPS, the world leader in logistics that has just about crash landed throughout the last couple of months. Now trading for $155 per share at a PE ratio of just 15.8. But please note our macro environment for this one, especially given supply and demand shifts and businesses that have been, well, in cost-cutting measures as of recently, industry to industry. Now, longer term here, we have over 106% worth of appreciation the past decade, all while analysts remain bullish on a comeback here to $172.24 per share. That's nearly 10% worth of upside. Not to mention smart money moves that have been made rather recently, with hedge funds buying more than 5.6 million shares worth of UPS last quarter. But given we are here, of course, for the dividends, go ahead and get to Simply Safe. We have a yield coming in at 4.17%. Not exactly as safe as the other stocks on the list today, but on the higher side for you, relentlessly growing by 13%, at least over the last 5 years. And while speaking of a solid dividend growth player, I now want to present you with a very low-key, industry-leading chip maker currently struggling amidst our economic environment with these macros thanks comes to inflation and supply and demand shifts, we have Texas Instruments, that's ticker symbol TXN, which is really set to soar into the future, though right now it's only trading for $157 per share with a PE ratio at a low here of 20.2 for Texas Instruments. But here's the real magic when it comes to investing into a company like Texas Instruments that plays an instrumental role in where the future is heading. Nearly 400% worth of appreciation when it comes to Texas Instruments over the last decade. Analysts who can still see 5% worth of near-term upside to $164.80 per share. But hold on for the long term. Just enjoy the dividends here because it scores a 90 at Simply Safe, a 3.29% dividend yield, and a very, very key metric here, strong growth rate over the last 5 years by over 17%, which again is just outstanding. Now, investors, there you have them, 7 dividend growth stocks to add to your watch list for this upcoming week. Comment down below on which ones you have in your portfolio you're thinking about investing into. If you're looking for more dividend stock ideas, you're going to find them right here in this video. But before you actually click away, just make sure you're subscribed. And of course, I'll see you then in the next one.